Our session here is going to be about the Iron Condor. We'll break that up into simple pieces and put the trade together. We're going to get a little more advanced here and a little more detail. How many of you trade the Iron Condor or are familiar with it? So some people trade it, some people have familiarity, maybe half the crowd doesn't. So this is going to be a good session to take a step back and look at the pieces of the Iron Condor, why you would use it, and then put it together into a trade. We'll also walk through position management techniques, strike selection, expiration selection, and things like that. So we've got a lot to cover today with the Iron Condor. My name is Ed Model. I'm the Director of Retail Education for the Options Industry Council. I'll be presenting this and the next session. And with me for this session is also Dan Kerrigan, the President of NASDAQ Futures. So we'll be co-presenting today. Feel free to ask your questions live, and feel free to send those through online. We'll take those as well. Here's our disclaimer. Most notably on this disclaimer, we do not include the costs of commissions and transaction costs. And I'm specifying that because we are going through strategies in these sessions that have multiple pieces, 2 legs, 3 legs, 4 legs, and as you enter these trades and then manage them or roll them, commissions can add up. Now, all the prices we go through online today, we've created those prices through an options calculator, but we don't include transaction costs. And I hear that, just remind everybody, turn all phones off, please, if you don't mind. So we don't include those transaction costs, and it can certainly affect the risk-reward profile as you make more trades and change positions. If you haven't been to our website, optionseducation.org, please visit there. We have plenty of online material, videos, podcasts. That's where you can reach out to our support team. Options@theocc.com is the email to the investor services team. They will respond to your options questions within 1 business day. The parent exchanges, here are the 5 of them. What I like to say about here is this is where all the action takes place. Most of you indicated that you trade options. When you send your order through your brokerage firm, it ends up being represented at the exchange level, and that's where the executions take place. The exchanges decide what stocks will get listed options. Not all of them have options. And you might be wondering, what criteria do they use? And there's a list of rules that they follow regarding a stock trading on a national exchange, trading over $3 per share, trading a certain level of volume. The exchanges vet the stock itself before deciding, are we going to list options here or not? And they give themselves the flexibility to decide when to list options. The exchanges want to give the investors what they want. They want volume, they want activity, and they want to provide as much as they possibly can for the investor without going overboard. There's almost 1 million listed options. Across all of these symbols, across all of expirations, almost 1 million of them. That's a lot of technical requirements on the back end. That's a lot of requirements on market makers who have to put bids and offers up. So they don't take the decision lightly, but they do decide when to list options and when to list strikes and expirations as well. Annual options volume, you saw the explosion at the turn of the century. Electronic trading had a lot to do with that. Do-it-yourself investing played a huge role. Learning about options and the awareness of options through online educational sources like OIC. We've been around since 1992. A lot more have popped up since then. Brokerage firms and exchanges have excellent education as well. So we had a huge uptick in volume at the turn of the century. And then we had a spike in 2011. Who was trading the markets in 2011? Who remembers that? Many of you. The European sovereign debt crisis caused an increase in volatility in that year. We had a spike, got over 4 billion contracts. That was an interesting year for myself. Quick story about that. I came from the trading background myself, started in the business in 1997 on the trading floors in Chicago and here in New York. I quickly moved into the electronic environment after that when the trading floor really wasn't conducive to market making. So I went from yelling and shouting at traders and people in the pits to yelling and shouting and punching my computer screen. So I went from pits to electronic. I always knew I'd get into the service side of the business, and I ended up as a Series 3 licensed broker in Chicago for MF Global. Who knows that name? MF Global. You don't know it anymore. MF Global used to be the biggest and the best broker in the futures brokers business. I thought I found the best job I could get. Started working for MF Global in 2010, developed some clients. Things were going extremely well. In October of 2011, MF Global announced their exposure to European sovereign debt that the market hadn't known before. Their credit rating was downgraded. They quickly went into bankruptcy and shocked us. We didn't know they were going out of business. I was talking to clients on the phone in our office in the Chicago Board of Trade building in downtown Chicago, and I remember the day very well, one of my best clients. And when you're a futures broker, you talk to your clients all the time. They are highly leveraged. Products are moving quickly. So you're talking to your clients multiple times a day. One of my best clients I was talking to in the morning, and he said, Ed, am I going to hear from you this afternoon? Am I going to talk to you this afternoon? And I honestly answered, of course, why not? I'm going to be here. I'll talk to you this afternoon. I hung up the phone. About an hour, hour and a half later, Board of Trade Security comes up, maybe 24 of them. They get in front of us, and they say, okay, folks, you have 30 minutes. Clean out your desk. Say goodbye to your colleagues. And then line up by the door. We have to search you and search your bags before you leave the office. That's how it all ended. And there were people who worked together for decades in that office, and they kicked us out, watched us clean out our desks, and patted us down and checked our bags. It wasn't the best way to end it, but I understand why they did that. There's so much sensitive information in that office. I had the contact information, the names, the financial condition, the address of all of my clients. That cannot go with me. They had to make sure that it didn't go with me. So they surprised us and kicked us all out immediately. That was my 2011 experience. We had the spike in volume there. After that, a lot of nothing. Low volatility, markets moving slowly. The VIX was well below its long-term average. But the options market was resilient. We were still trading around 4 billion contracts a year. And then the spike in 2018 with increased volatility and uncertainty from a micro and macroeconomic perspective. And we got over 5 billion contracts. We're not on pace to do that this year, but we're close. So the options industry is thriving, and it's continuing to show signs of growth. Here's the outline for today. We're going to break apart the Iron Condor into pieces first, and then put it together. We're going to look at the risk profile, management techniques, what you need to look out for, and how you put this trade together. Who's familiar with vertical spreads? Bear call spreads, bull put spreads? Some of you. This is where we're going to start. The bear call spread. This would be the top half of the Iron Condor trade. Two pieces involved with this spread. First, you are selling a call, and then you're going up higher in strike and buying another call option. So two calls, selling one and buying one. You're selling the lower, more expensive strike and buying the higher, less expensive strike. When you sell any option or you sell any spread, the most you can make is the credit received. So in this case, we've sold the more expensive, bought the less expensive. We have a net credit. The most we can make on this trade is that net credit. It can only go down to zero. It can't go below that. So the net credit, the gain, is the max gain we can achieve. Max loss. What's the worst thing that can happen? You have to know this as well. The max loss would be if both options end up in the money. We've sold this spread. We want the market to stay away from it. And there's your first clue. We'll get into more strike selection later. But we sold something, so we want the market to stay away from it. We sold an expensive call. We bought a less expensive call, and we want the market to stay neutral or move in the other direction, which is lower. The worst case scenario is it moves in the direction of the strike prices. We want that if we're long options. We don't want that if we're short options. Here we're short. If the stock moves higher and goes through both strike prices, that's the worst case scenario for us. We're obligated through that short call to sell stock at the strike price. But we have bought a higher strike to cover that risk. If we're obligated to sell at this price, we have the right to buy back at the higher price. That's what the options rights and obligations give us. So the worst case scenario is the stock goes much higher, we deliver shares at the lower price, and we buy them back at the higher price. That difference is what we might have to give back to the market. Giving that much back minus the credit we received up front is our maximum risk. Does that make sense? You receive something up front, that's what you get. Question is, how much is the most I might have to give back under worst case scenario? In this case, difference between the strikes minus the credit received. Break-even point provides us with a good chance of success when you sell a bear call spread. The reason why I say that is you have a stock trading at a certain level, and we received a credit by selling an out-of-the-money option, and we bought our protection further up. The break-even point is going to be the short call strike plus the net credit. We've given ourselves a nice buffer for how high the stock can go before we've reached our break-even point. That's why a bear call spread might be looked at as a trade where your risk-reward, the amount you can make versus the amount you could lose, might not look favorable. Generally speaking, the amount you could make is less than what you might lose. And many of you might be taught to look at the opposite. You want 2-to-1, 3-to-1 in your favor. A trade like this isn't necessarily like that. It's the opposite way. But the idea here is your chance of success, or your batting average, will be high because the stock can rally up to your short strike plus the credit before you break even. You have a nice wide range of profitability. Not to mention, a stock can go in 3 ways. A stock can move 3 ways, up, down, or sideways. In this case, it can move sideways or down or slightly higher, and we're profitable. It's a big move higher that we have to be concerned about. So that's your break even. Forecast, I just outlined for you, we're neutral to moderately bearish. We don't need the move lower, but this trade is consistent with a bearish outlook. Neutral will profit as well. But because bearish is the outlook, what's our delta going to be, long or short? How many people are familiar with deltas and Greeks? And some of you. So we have this trade here. We're short a call, more expensive, lower strike. We're long a higher call, less expensive, higher strike. Is this trade going to be long or short delta? Short delta. We're selling a more expensive, lower strike call option. Selling a call is a short delta trade, meaning it profits as the market goes down. So we're short delta by selling that more expensive call option. We purchased deltas, but not as many. So we're net short delta. That's consistent with a bearish outlook. So bearish or neutral here will profit. Now volatility. I'm going to start pushing things a little bit deeper as we get into Greeks. And this is going to make sense when we put it together into the Iron Condor. We have volatility now. Are we long or short volatility when we do this trade? And specifically, I'm asking about, what's our volatility exposure? If volatility were to increase, would we make or lose money? We'd lose. So if volatility goes up, we lose. Opposite directions means we're what? Long or short? Short. We're short Vega. You guys just answered it. Some of you may not know what Vega is. You may be daunted by the Greeks or the terms of Vega, but you just answered it. If volatility goes up and the price of options goes higher, we sold this spread. That's going to work against us. Volatility goes up, that works against us, short Vega. Time decay. This is what we're trying to capture. Time decay here is positive. With each passing day, every time a day passes, we make money. So we have short deltas, we're short Vega, and we're long theta. Positive time decay is working in our favor, and that's what we're trying to capture here is that time decay. Assignment risk is interesting, and I'm going to spend a minute here talking about early assignment and when that might happen. You have to be aware of that. If we're short a call option, we have to wonder when we might be assigned. Now, with equity options, you can't be sure ever if you're going to be assigned. That's an educational statement. What you're doing is evaluating the likelihood. When the stock is way away from the strike price, it's a pretty safe bet that you won't be assigned, but you're evaluating the likelihood. If the stock is very close to the strike price, you have to start getting concerned. Am I going to get assigned here or not? Now, who knows what circumstance in the market? It's a one-word answer. What circumstance might lead to the early assignment of a call option? A lot of people knew that. A dividend payment. Think about this from the option holder's perspective, the long call holder's perspective. If they own a call option, they are not entitled to a dividend payment. What they have as an asset is a call option that may have intrinsic value and time value. They don't get the dividend. A stockholder, if they own shares at the strike price, they would also have the intrinsic value. They'd be able to capture that. But instead of the time value, they would get the dividend payment as a shareholder. On the day prior to ex-div, if that dividend payment is greater than the time value, the option becomes a candidate for early exercise. not a guaranteed early exercise. It would be in the financial best interest of the option holder to exercise the call, give away the time value, get the shares, and receive a larger dividend. It would be in their best interest. But what else can they do? What would be another choice for the option holder? Instead of doing that, they could do both. They could sell the option, receive the time value, and then go out into the stock market, buy shares, and get the dividend. They could do that. If they could sell the option for time value, then they can go ahead and sell that, buy the shares, get the dividend, and capture both time value and dividend. So when you have that circumstance of dividend greater than time value, it's a candidate for early exercise, but you're not sure. If there is zero time value, absolutely none, then the likelihood of early assignment goes up dramatically. So that outlines the bear call spread, and here's the P&L graph that really just visualizes everything I just talked about. Where is your risk? Where's your reward? As we drop down below 90, that's our max gain. We start to lose as the stock rallies. We walked through our break-even point, short strike, plus the premium received. We have up through 91.70 before we start to lose money on the upside with the bear call spread. So keep all of this in mind as we go through the pieces and we start to put together the Iron Condor, and then we're going to manage through that. The next side to this is going to be the bear put spread, and Dan will walk through the bull put spread.
I love selling options, and this strategy is a great way, consistent with what we talked about in the first presentation, is to take advantage of a neutral to slightly bullish, sir, as you said, the upward channel moving, and this entails kind of an oxymoron. We all know puts are based on the market going down, and bull is the opposite. But combined, this is an ability to express a view on the market going higher. So we're going to sell a high strike put, and we're going to buy a lower strike put, and we're going to put some money into our pocket, and that's going to be our gain if the market starts to go higher over time. But the maximum loss in this case is equal to the difference in those strikes minus that premium that we put into our pocket. Oh yeah, there's definitely a kind of a nuance here, is that if you're trading on a stock and you get to expiration and this market goes down, if the long put has expired and the short put was assigned, you could have some assignment risk. But just like everything Ed said, time decay is your friend. And bull put spreads fit neatly into my personal strategy because, as we were talking out on the side, I love selling options that are 50 days out or having a strategy that is 50 days out. Monday will be that ability to look at a strategy for the monthly August options. In terms of volatility, a little increase, you could have a slight impact, but this is really, again, a neutral to moderately bullish strategy. And of course, here's the charts. I know the charts are here for a specific reason, to give you kind of a pictorial representation, but I always like to look at this. How much money did I get put into my pocket, and how much do I stand to lose if it gets taken out? And again, in terms of the risk here, it's simply the amount of money that you may lose is limited to the difference between the two strikes minus the money that you put into your pocket. So in terms of putting these two, I think, Ed, you said we got to put these Iron Condors together, and this is the idea when they're flying around town. What is the common denominator of these two strategies, the bear call and the bull put spread? I'm going to save the drama here. Two words: neutral and income. And if there's one takeaway from today's group of three presentations, the fireworks here are how to shed light on your portfolio for income-producing strategies. But you don't have to have a perfect view of where this market's going to go, up or down, just to have a neutral view. So in terms of neutral view, you're not sure where it's going to go, but you have time on your side, and the commonality of income, these are winning combinations. So I think we're coming back to you, and we now need to put these two together. How can they work this into their portfolio? And let me ask you a question before you get going. This is like a lot of legs. You're talking about 2 legs in your bear call spread, right? And you're talking about 2 legs in the bull put spread. It's 4 legs. How are we going to go in and do this on the online retail brokers? Is there simple functionality, or do they have to like figure this out 4 times over?
Yeah, it's a good way to start this. Because you have a fairly complex trade with 4 sides, it is most likely that your brokerage firm could facilitate 1 order for this entire trade. Most of you are familiar with how your options are presented to you on your platform, and you likely have a selection of strategy. The best platforms let you select Iron Condor, and it will pre-populate 4 legs for you, and then you can go ahead and send those on through. You have to be a little bit careful when you do that. I'm glad we started this way, Dan, because if you're going to enter 1 trade, first of all, you know what we're doing here. We're trying to receive income, and that would mean your price is going to be a net credit. You have to be very careful as you're now adding 4 pieces together. Generally speaking, it's a good way to do this trade instead of legging into pieces, because 1 trade might yield a better execution price. You can take the midpoint of all 4 sides and do the simple arithmetic associated with each and come up with 1 price for the entire trade. And since we're selling it, there's your starting point. If you want to be aggressive with the trade, you can sell at a price a little bit below that, or maybe far below it if you really want to get this trade executed, or if you're willing to wait a little bit, start at your midpoint and move up. But just be a little bit careful with the arithmetic. You know you're selling 2, add those together. You know you're buying 2, add those together, and then take the difference between those 2. You'll see that a little more clearly. We do have an example here of the Iron Condor, but you should be able to do that all at once on your brokerage firm platform. And here's what it looks like. So an Iron Condor is merging the 2 trades together, the sale of the bear call credit spread and the sale of a bull put spread. Usually it's out of the money options. You could stagger or change that a bit, but generally speaking, it is using out of the money options. And these 2 profit and loss graphs that we walked through are going to come together in a few slides when we show the P&L graph of the Iron Condor itself. And when you merge these, some things are going to come together and be enhanced, and we're going to change the risk profile in what I would say is a fairly dramatic way, and comparing what I said earlier about risking more than you can make when you do the call spread. When I went through that, same story is with the bull put spread. Things look a little different when you put those together into the Iron Condor. Here's where we're going to talk about volatility and time decay and choosing strikes. One common thought is that higher premiums are better to use, higher volatility is better to use than lower volatility. But the key here really is that future volatility is lower than current volatility. Not just that prices are high, but that you have an expectation that prices are going to drop. So it's very easy to just look at prices and say, wow, those are very high premiums. I want to sell those. And I understand that, believe me. It's enticing to see, wow, look at that annualized return. That's incredible. I really want to sell these options. But you also have to realize market makers aren't giving that away for free. Market makers know what they're doing. So prices are set accordingly, attached to volatility levels in the stock itself. Selling something at a very high premium doesn't look so great when the stock goes crazy on you. And when you're selling spreads like this or any other credit spreads, that's what you're trying to avoid. So be careful about just looking at higher vol levels, higher premium amounts. I don't want to discourage you from that because there's certainly opportunity there. But you have to realize why those premiums are high and make the appropriate decision. If you move closer to at the money, you are going to achieve higher premium amounts and a higher net credit. But if you move closer to at the money, you're also increasing your risk. Those 2 things go hand in hand. If you decide you want to make more, you're going to have to risk more. Choosing more narrow strikes is going to give you a higher potential return, but your break-even points will be closer. More risk, more reward. Yes, sir?
Would you go closer
question is about earnings dates and trading these around earnings because of the effect of I-vol around earnings. Earnings is a popular time to trade options. On the floor, I loved earnings season, couldn't wait for it. As an investor, if you're trading options, you might feel the same way. Because prior to earnings, a very uncertain stock movement in the near future generally leads to high implied volatility levels and serves themselves to credit strategies. But what I just said, the concept I just walked through is if you see those premiums, there's a reason. The reason why those premiums look so juicy and so enticing but prior to earnings is because the possibility of a big move is coming with the earnings announcement. Now, one thing you can feel pretty comfortable with is that after the earnings announcement or press release or whatever it is, the implied volatility level is going to drop once the news is out. So that's going to work in your favor. What you're trying to make sure is that the drop in implied volatility works in your favor to a greater extent than the stock moves against you. When you're selling options, you want the stock to move very little, to stay neutral. You're selling implied volatility, you're selling options. After an earnings announcement, volatility is likely going to work in your favor. What might not work in your favor is the stock move. In other words, the delta. The delta might work against you. So you're weighing those two things. Good question. Short strikes and long strikes. We just walked through this a bit. How do you choose your shorts and your longs? Can't give a specific answer on this, but short strikes, in general, selling options, you are selecting a strike that you believe the stock will reach but not breach. That's just a little phrase that I use. You think the stock might go there, but not beyond that level. That starts where you select a short strike, and you can do that on both ends when you're looking at this trade. We're selling a call on one side, and we're selling a put on the other. So let's start just with those two. And you can do your analysis, technical, fundamental. It's not up to me to say how you form a market opinion or what technicals you use or how you identify those bottom support areas and those higher resistance areas. But once you do have a feel for a range of a stock price, where it might be headed in the future, that leads you to your short strike prices. Then you can look at what premiums are available there. See if it's worth it for you to sell at those premiums. The next thing we have to do is get the long strikes. Now, generally speaking, the long strikes are chosen in more of a monetary, calculated fashion based on how much risk you're willing to take. The long strikes are the protection. We sold options. The worst thing that can happen is both the short and the long go in the money. So how far up am I willing to go? The higher you go in strike, or the lower on the call, the lower you go on the put to buy, the more premium we're going to get, the higher credit, the higher reward, and the more risk. The width between those strikes is our risk. So you have to decide, how much risk am I willing to take? That can be your starting point for selecting shorts and then selecting your longs. Once you have that framework, price the whole thing up. Add up the shorts, add up the longs, subtract them from each other, look at how much premium you can get for this condor, and decide, is that worth it for me? For this premium and for that potential loss, is it worth it? That's just a little backdrop on how to select strikes on the short and long side. What about expiration? You know, this comes up all the time. How do I select an expiration date? We're selling options here. We're trying to receive and capture premium, and we want it to decay. Generally speaking, that 40 to 50 days until expiration range is when it's understood that time decay begins to accelerate. The erosion of option premium begins to accelerate right around there. It's very slow for long-term options. Right around 40 to 50 days, it begins to accelerate, and then it continues to accelerate all the way through expiration. It gets faster and faster and faster. The greatest rate of decay you're going to have in an option is the last day. Its rate of decay is going to be 100%. It's going to go to zero on expiration day. However, the premium at the beginning of the day might be very low. And what I always say here is an option worth selling for a nickel? Maybe not. Maybe not ever. On expiration day, that nickel is going to become zero. That's 100% decay. It doesn't get any faster than that. But it still might not be worth selling anything for a nickel. So you're trying to toggle when's the best time frame to sell where I can get a good amount of decay, but I'm also getting enough premium to make it worth my while. You know, and again, I can't answer when that is. 40 to 50 days is a starting point for people. Some like to go a little bit further out and get a higher premium. Some like to go closer and sell 1 week, 2 weeks out, get very fast decay, and they're willing to accept a smaller amount of premium for that. You have to find a sweet spot for you. Others will sell further out, 40, 50, 60 days, and then at some point when the option gets cheap enough, close it and not hold through expiration. The same concept as what I just said. Would you sell anything for a nickel? Well, what if you already sold it and you're holding an open short position in your account and now it's worth a nickel? If you wouldn't sell it there to begin with, would you hold it there? Maybe, but and I'm not going to say you wouldn't. Some people say, I want every penny. I want every single penny of this option. I'm waiting, and it's going out to zero. And maybe if the stock is nowhere near the strike and you don't want to bother buying it back, that's up to you. But when options get really cheap from the short side, that's when you start to consider maybe it's worth buying back. So rather than just thinking, when am I going to sell? What time frame do I sell? Also consider, do I manage? Do I buy back at some point? And that's a little bit about time decay and managing a position. So we're going to put this together into a specific trade and then walk through it in great detail. So here's numbers. Stock is trading at 139.5, and you can do any analysis you want. You can look at moving averages, support resistance, any technicals or fundamentals you use. Here we are simply looking at a 52-week high and low, so that helps us forecast our range. And in this case, we believe a nice range for this stock upcoming is going to be between 135 and 145 a share. We've defined through our market analytics, whatever they are, that 135 and 145, the stock's not going through either one of those levels. And there sets our short strikes. Selling the 135 put and selling the 145 call. We can go as far out as we want on the long side, but remember the long side is our protection. How much are we willing to lose on this trade? What's our risk capital? That helps us set what the long strikes are. Here we go 5 points wide, and we buy the 130 put and the 150 call. As I said, if you're entering this trade online, it's rather simple arithmetic. As one Iron Condor, you will be adding the options that you sell together. You'll be subtracting that from how much you purchase. In this case, that nets out to $315 per contract. I would expect that you can enter in sell to opens and buy to opens on all four sides as an Iron Condor on your platform and put it in at a price as a net credit of $315 all at once and execute all four sides. Here's the two spreads, left to right. The put spread on the left, the call spread on the right. And just a little bit about how they do neutralize each other. We walked through how much credit you're going to receive. That's just adding up the option premium amounts that you see on the open market. That's $315. The maximum risk. We calculated that before. The worst thing that can happen is both options go in the money, and we have to give back the full $5. We walked through that when we went through the verticals. With the Iron Condor, the market can't be in two places at once. It can only go higher or lower, but it can't do both. So we would either be giving back $5 on the call side or $5 on the put side. One or the other, but not both. Is everyone with me on that? If we received $315 up front and we can only give back $5 on one side or the other, all of a sudden now our maximum risk is $185. And again, keep in mind, we're not adding in commissions and transaction costs. We have developed these prices straight from an options calculator. So you would have to tweak that for the associated costs. But now we've flipped that risk reward back in our favor. Whereas with the vertical spreads, it was not in our favor. Here it is. We can make more than we could potentially lose. In order to achieve that, we had to sell spreads on both sides. Remember before when we walked through the verticals, we said, well, the market can stay neutral or it can move away from my options and I'm profitable. Here, it has to remain neutral. We're short options on both sides. So we need that range to come through for us. This is a truly neutral trade. If you're neutral or bearish, or if you're neutral but you might think the stock goes higher, then one of the verticals might be a better trade. If you are truly neutral, then the Iron Condor may facilitate that a little better. This is a good time to start walking through some what-ifs, expiration graphs. What happens if the stock's up or down? And we'll take a look at what that looks like. Dan?
And I just have a question for you.
Yeah, sure.
You said about spreads on both sides. This presentation is all about the assumption on a stock, right?
True.
But could you do this on index options?
Sure. Yeah, so everything we're walking through, different strategies today, could be used on index options as well. Now, the difference between equity index options are a bit nuanced but important. If you're using index options, you don't have the early assignment characteristic. We walked through that earlier. When might that happen? You have to be concerned about that. On the call and put side, you do. With index options, you don't. Index options are European style, which means they can only be exercised on expiration date. So you don't have that issue. And the other thing to keep in mind with index options is they don't settle into shares the way a stock does. So an index option settles into cash. So there's a few different things you need to be aware of when it comes to index options. But certainly all of the strategies that we're using today can be applied to index options as well. Question, sir?
Could you use this strategy in this kind of environment that we have right now? One tweet's going to go up, one tweet's going to come down.
So current environment. Well, I'm a bit limited in what I can say about what I think is going to happen in the market. So you would have to tell me, could I use this if I really believed the stock or the market was going to remain neutral? And I would say this strategy is consistent with a neutral outlook. One thing I can say in addition to that, and we probably would get to this later anyway, so might as well just address it now, is you don't have to put this on all at once. It is certainly, now when you're learning about option strategies, and we're going through a number of them today, what you're doing is you're putting things in your toolbox. And the hard part is knowing what market environment am I dealing with and then pulling out the right tool. Like, when am I going to use this strategy? If you're truly neutral, here's a good strategy for you. If you are neutral but you're a little bit bullish, then maybe start with just the bull put spread on one side.
You are neutral, but the tweets or the news will come out, and then suddenly goes up, and the following day it comes down.
Sure. So I think you're asking about unexpected news, big moves, maybe flash crash, and the market comes back. Well, one thing you can, and Dan, you may have thoughts on this as well, one thing you can take comfort in with this spread is that you do have the protection on both sides. You know exactly what that is. And if you don't manage through the trade or panic or do anything different, if you do have a big move and you're comfortable with the trade and the risk profile when you put it on and you come back, the trade's right back where it started. That actually would work out well for you. What you're concerned about is that the market makes a big move and doesn't come back. That's the concern. But a move back, exactly what I just said. You can start with one side, and if the market moves higher, you can sell the calls, and then you can decide at that point, do I want to buy back the puts or leave them on? I mean, you can do all sorts of things, and you're right, and your question could go on, because with options, there are so many different ways and variations of the ways you can do things with respect to entry and position management and so forth.
And we want back.
Yeah.
Back.
So well, your cost is going to be lowered, but at some point you're going to have the decay. Right, the decay is faster on your long options if you do that. At some point, you have further position management to do. So after the long positions expire, you would then either have to buy more, or you would have to exit the whole thing. And if you exited the whole thing, those long options would decay quicker than the short ones would. It's hard to say what that net would be. But you would just have to be aware. Right, that's a nuance you'd have to be familiar with, is the decay difference between the two. Sir?
In this case, where would you have the stops?
The question is, where would you have the stops? Well, using stops would likely be through one order as the Iron Condor. Would you agree, Dan, that if you wanted to put a stop and we sold this at 315, we want to get out if it goes up to a value of 4. We'd put that in at 4 as an entire trade. So if you want to use stops, it would likely be one order to exit with the opposite sides at one price.
Do it on the price of the option, not on the amount of the stock.
Question is, what price do you use? Right, you don't use the stock price. You would use the value of the spread in its entirety. If this spread reaches a value of 4 or 410 or 430, whatever it is, I want to exit. And that's a good question for your brokerage firm, because with complex orders like this, if you want to enter in a stop loss using multi-legs, make sure you clear with your brokerage firm that they're going to accept the order the way you intend and clear it out. Yes?
I was just going to say, optimally, using this example, you would want a net credit of $5.
Right?
Yeah, good luck.
My follow-up to that was, were you ever so lucky to do something like that all at once? Or like
Oh, heck no. No, no.
I just,
No.
just curious.
Executing all at once, you will not get $5. But if you legged into it, you might. And that was.
I love it.
Well, someone would have to make a heck of a mistake, and they wouldn't have a job the next day if they bought something from you for $5 that could never be worth more than $5. So the answer is really no. But legging into it could yield that if you did what was suggested earlier. You sell when the market's low, and you do the put side, and the market rallies. Let's go ahead and do the call side here. I mean, you could leg this thing back and forth, and maybe achieve much greater than 315.
I just kind of thought it ironic, and that's why I was picking your brain if you ever were
great.
fortunate enough to do so.
I wish I was. I don't think I've been on the wrong side of that, but I wish I was. So,
That question over here. Go ahead, sir.
yeah.
What are your thoughts on selling the strangle as opposed to, so for instance, selling the 135 put to 145 call and not buying the two protections but smaller positions?
So the question is about selling options but not buying protection. We'll get into a little bit of that on our next session here this morning. When you're trying to manage risk, there's different things you can do. We talked about using stop losses. You've just mentioned sizing down. Another one is using options and buying options as protection. When you size down, the risk profile doesn't change. Your monetary loss changes, but your risk profile doesn't. There are some disadvantages to just simply sizing down. One is certainly overnight risk, weekend risk. You don't have protections in place when you're just sizing down, and you could have huge moves one way or the other. When you size down, you also might not be receiving the type of risk-reward profile. Here we bought options, and we have 315 and $1.85. If you size down, you would have, I'm not sure what you would have, but you wouldn't have any long options of protection. So your risk profile certainly changes.
I call it a strategy. That strategy is selling the strangle. I
Yes.
call that short, bad things can happen.
Yeah.
So that's
Yeah,
my personal risk tolerance. I'd never do it.
It's
but-
a short strangle, which does have high risk. Sizing down is feasible, but you'd have to be really on top of that.
So you got this Iron Condor launched. It's flying. Now I think we got to get it landed. See what happened. So you said we sold spreads on both sides. These are the wings. So what happens at expiration? I think you did a nice job, and I think this gentleman out here said, "Hey, the ultimate payday is $5. That's where it could go. I love it. I love it." But the reality is, your maximum profit is what you took into your pocket, the $3.15 on this, and of course that would mean $5 minus that amount gives you a maximum loss of $1.85. So what happens in this case when the shares go below $130? So we know the call spread way on the upside completely expires worthless. But the short put now is in the money. You are going to get assigned. You're going to have those shares that are buying for you. Now, if the price is below $130, you remember you got that protective put, the protection that Ed talked about. That would be exercised, and that would take you out of that newly found long position. And again, right back to that maximum loss of $185. You can see the chart. Again, the chart is going to look the same no matter how many times you put it up. I like the writing on the left side, how it relates to me on risk. Here is the golden Iron Condor, which is what everybody's pursuing in a neutral strategy. Can you land this Iron Condor in between the 2 points of its shoulders? And that's the goal here. This one, however, is saying, didn't get up to in between the shoulders. You're still on the downside. what happens if one of your wings is wounded? That is, if the stock is between 130 and 135 bucks. Well, you're short that 135 puts, so you're getting assigned. You own them. These are yours. You aren't able to exercise that 130 put because it's way below. Now you have a long market position at the equivalent of $131.85. That's the strike of 35 minus the premium that you took in your hand. Where do you go from here? It's up to you. You could sell the shares at the market. You could sell a call against it. You could do a lot of things. But it just depends on how you go about liquidating that stock. Here are the golden wings. This is the allure of what Iron Condors bring to retail investors. I know the stocks are between here and here. If it goes between 135 and 145, you're in between the shoulder points. Everybody in here's got big shoulders, right? It's because you keep making money. You always know that it's going to settle in between there, right? The left wing has expired, worthless. The right wing has expired, worthless. You get to keep everything, $3.50. And the best part is you get to do this trade again, depending upon your view of that stock or an index. This is also what I like to call the commission-friendly part, because if you don't have stock assigned, you don't have another trade that you have to execute. So this gives you the ability to look at doing this over the year. Can I do 4, 5, or 6 of these in a calendar year? Again, another planning in terms of your portfolio management over time. All right, Ed, so now we're going to go between 145 and 150 bucks. We weren't right on that neutral strategy. What happens to us? We still get to keep that 315, right? But your $5 spread, now we got a problem here. This spread, we sold 145 call. And it's not above 150, so our protection doesn't kick in, so now we're short. I don't know how many people here ever take on short positions in their account. I can tell you 100% of the time, I never take a short stock position because it's not in my risk horizon. However, it doesn't mean it doesn't work for you because you have protection. So in this case, you would have a short stock position. It would be at 148.15. Got to decide whether you're going to cover it or do something different. Maybe buy another upside call if you want to manage a short stock position. A lot going on. Your Iron Condor took off, Ed. We're up above 150 bucks. What happens with this here? We know our left wing expires worthless in terms of the put spread. And now the short call of 145 has been, the 140 call has been exercised and the 145 call has been exercised. You're taking out your max loss now is 185 bucks. Sorry, you didn't get your $5, but you did get a ride on Iron Condor Airways. But the great news is there's no stock position, ability to put in another time for another trade for another time. So now I think we need to manage the position. And this is, I think, where the questions come. That gentleman, what happens? You said like earnings go up, something comes down. How do you manage this position?
There's a lot of different things you can do to manage the position. It's always maybe a lost art. We've talked about when to put the trade on and how it's constructed and what the risk-reward profile is, and that's great and all. What sometimes gets lost is what happens if things start to go wrong with this trade? What can I do or what should I do to maybe mitigate the loss or to try and manage this in a way that's not so painful? And it's not easy to do. One thing to keep in mind as we walk through a couple of these examples is when you are rolling a position or you're changing it to try and mitigate a loss, generally what you're doing is you're closing something out for a loss and then reestablishing a new position that's now consistent with your current market outlook in effort to make back the money that you lost. So I always have a little bit of a little disclaimer to put on. We're not mitigating losses, or we're not delaying a loss or putting off or avoiding a loss. Rolling and changing the position is a way to keep the trade going, but to try to make the money back off of what we just closed out. For this particular trade, that happens when we're prior to expiration and the stock has moved in one direction or another. It's threatening one side. So we're having one of those verticals start to increase in value and the other is decreasing. One's working against us and one is working for us. And we want to walk through an example of either side of that. First on the downside, and then up on the upside. On the left side, we're reminding ourselves what the original position was. Stock at 139.5, and we know where our break-even points are up at 148.15 and 131.85. That was our short strikes plus the total premium amount that we received. Yes, sir?
What's that word roll? What does that mean?
Question is, what does roll mean? It really means closing something out and then reopening something else. You're taking this position and rolling it to something else.
You're going to close it out and start over?
The question is starting over. It's somewhat like reestablishing a new position with different terms. So I have this strike price, and I'm going to change it. I'm going to close it out, and I'm going to open this strike price instead. Or moving expirations. You're rolling from one strike to another, or you're rolling from an expiration date to another. You're changing the construction of the trade from what you had to something new. And that's really all that rolling means. So,
Excuse me,
yes?
This whole thing is based on assuming that the stock price will be between 130 and 150 during the whole time that the option is active, right?
So the question is about assuming that the stock is going to be between 130 and 150, and you can't assume that. And what we're going to try to address here is what if that's not the case?
Well, that's a very tight range. I mean, why would you? Well, you would have to have a
Well,
good reason to believe that that's going to be true.
You certainly would have to have a good reason to believe that that's going to be true. Yes. And what we're going to try to address here is what if the stock is not in that? What if it starts to threaten one side or the other, and you haven't gotten the range that you expected? Here we have this 17-point range of profitability, 8.5% move on either side that we can be profitable on. But what if the stock moves in one way or the other greater than we thought? In this case, it moves down to 132. So now our put spread is threatened. All of a sudden, we got a quick move. We weren't expecting that. And we're starting to see that maybe this thing goes entirely in the money. Well, as I mentioned in one of the previous questions, one comfort level is we know the worst case scenario. We know if it goes much, much lower, what we can lose is $1.85. We calculated that up front. But this is options. You can do different things. So rolling in this case would be closing the original call spread that we have. It's not being threatened. The stock's moved lower. Maybe that call spread now is very, very cheap. We can now buy that back for a small amount and roll down the strikes. Instead of leaving the 145, 150 call spread on, we can bring that down, see what kind of premiums are available, and maybe get a little more credit than we started with. That's the idea here. Close the 145, 150, and then roll it down. Sell the 140, 145. You would do that if you could increase the credit overall from where you started with. In our example, we're able to do that and change the complexion of the trade entirely. We received $1 to close the call spread and sell a new one, net credit of $1. That brings our total credit up to $4.15. Now what do we do from here? Well, we've received more credit. On the negative side, we've greatly reduced that break-even point on the upside. That's what we give up. That's rolling down one side or the other. And as we come to our closing minutes, let me get to this other side of the trade. This one's a little more complex. So if you have questions about it, we'll certainly be glad to answer them when we're finished here. Again, the left side of the screen is the original position where we started, stock 139.5. We think it's going to be in this 17-point range. What happens if we're wrong and it really moves in a big way? In this case, it goes to the upside up to 152. That's beyond our upper strike. So now our call spread is entirely in the money. Not just is it threatened, we're in a losing position here. Remember what I said before about rolling? You're really not avoiding anything. You're not mitigating. You're closing something and establishing something new. If we now thought, hey, look, we were a little bit wrong. We established this trade at the wrong levels. This move happened. Okay, now the move is over. Now we're sure we should have done the trade now, not a week or two or three ago. We should do it now. In that case, closing the spread and establishing a new one is all rolling is. It's a rather simple concept. I don't want rolling to confuse people because, again, all you're doing is closing something out and putting on something new. In this case, we've closed the old spread out. It was a loss. We took our $1.85 loss. We reopened a new Iron Condor. We're neutral at this level, and we're going to sell a new one. That 250 comes from analyzing this as one long trade. We lost $1.85. Now we're selling a brand new spread for $4.35, and the net credit is 2.5. If you're tracking this as an ongoing position, it would be netted out at 2.5, and that changes the risk profile. Things to know. I'm just going to put all these up on the board. You can lose on one side or the other, but not both. Generally, your risk profile is going to be a bit in your favor, as the credit received will likely outweigh the potential overall loss. Pay attention to volatility. If you look at volatility, an increase in volatility will have a negative effect. If you don't track it that well and you see the market hasn't moved much, but my premiums have gone up, what's going wrong? When you see option price movements that you weren't expecting or that don't seem to be consistent with what the stock is doing, implied volatility frequently is the reason for that. So be aware, you're short volatility here. If it moves up, that's going to work against you, but time is on your side. Time is working for you with each passing day. Did have one question that came in online I wanted to address. The question is, do you look at deltas when choosing strikes? It's a good question. Frequently, investors do look at deltas. One of the loosely held definitions for delta is the probability that an option will finish in the money. That's not entirely mathematically correct, but it's a rough estimate. So if you want to just say, well, look, I want a 70% chance that this option is going to expire out of the money, then you can look for a 30 delta option on either side, and that is roughly the market's expectation for what strike price would finish out of the money 70% of the time. And you can use that delta analysis to help you choose your strikes. And again, please visit our website, check out our YouTube, and send questions to the investor services team. They are there to help you and answer your questions about options. So thank you very much for attending session 2, and we'll see you soon.